Hi, this is Leo Kelly, CEO of Verdance Capital Advisors, coming to you today with our coronavirus update for April 9th, 2020. And as you can see, we're here with our skeleton crew again. I'm growing my coronavirus beard, and we're going through the process of trying to analyze a lot of data which is coming through over the last week or two. So the news, as we have suggested over the last couple weeks, continues to get worse in the moment. Cases are up around the country. They're going up very quickly as testing increases. We would say that's good news. The more testing, the more knowledge we know who has it is a good thing. The death toll is increasing. That's not a good thing. However, this week we started to get some promising news, light at the end of the tunnel news. The amount of hospitalizations in New York and a couple other hot spots are going down. And so while the death toll increases, the preliminary steps that get us to that point, hospitalizations, intubations, ICUs, all of those numbers are going down, which means the death toll should start to turn over. Now, again, this is an unpredictable virus, so it's not time to call all clear yet, but the signals are good on that side of the ledger. Additionally, we're continuing to see more and more data come in around therapeutics, more advancements on vaccines. The faster testing from Abbott Labs is showing promise, and we're starting to hear about antibody tests. Antibody tests are incredibly important if we're going to get back to work, because they will not only tell us if you have coronavirus, but equally important, if you've already had it. Again, this is a weak virus. So many people have it and don't even know they have it. They may have already been through it and not know they ever did have it. And those folks, it is believed, can get back to work early and get this economy going again. So, as we've talked about for the last several weeks, there is so much attention, there's so much effort being put to the point, the tip of this spear, and everyone's working on one outcome, and we're starting to see the impact of that. The science is advancing quickly, and the good news is some of the models that we were a little bit suspect of are proving to be a bit incorrect and not quite hitting the mark. The good news is they're doing that in our favor. Less hospitalizations, less deaths, and a faster turnaround on coronavirus. So again, not out of the woods on the biological side, but the news is improving. In terms of the economy, well, the estimates are getting bigger and bigger in terms of the decline that is expected in the economy. Actually, it's almost like a game now. Who can put the biggest downturn number for the second quarter? Nobody knows. This is unprecedented. We don't know when we're coming back. Anybody who gives you a definitive number, it's a guess. Anybody who uses a decimal place has a sense of humor. We don't know what's going to happen here. Goldman Sachs just came out with a 34% decline of GDP for the second quarter. Again, that's been the most dramatic that we've seen. By the way, Goldman Sachs predicts a 20% increase in the third quarter and the market to be up by year end. So we continue to walk through this process of trying to understand how deep we're going to go and how fast we're going to come out. The estimates are severe, but again, we expect a very dramatic snapback. Stimulus is really starting to hit. That's one of the good news factors in the economy. The Fed has poured a tremendous amount of money. The $2 trillion stimulus is starting to go in. The Fed just today announced new facilities to pump in billions of dollars to help small businesses, and we're starting to see that impact. It's getting in the economy. M2, which is the measure of money, has increased dramatically. In fact, it's up about 12%. This is important. In 2008, when TARP first came out and money was going into the system, M2 didn't grow. What does that mean? The money went in, but it didn't actually get to the economy. In this case, the money's coming in, M2's growing. That means it's getting into the system very quickly, and that's good news, and that gives us some hope. The Fed's balance sheet is growing tremendously. It is now approaching $6 trillion. Put that in perspective, before the crisis, it was $400 billion. Post-crisis, we grew to $4 trillion. Now we're approaching $6 trillion. The Fed is active, the Treasury is active, and we're starting to see that activity. Cash is building on the sidelines. That's normal in a bear market. It's actually a counter indicator. When cash rises, that tends to signal bottoms. And we're seeing a very rapid growth in cash. I just saw a study on 401ks. One of the most active periods in 401k history was the week the market made its bottom or its recent bottom. And of course, what were people doing? Pulling money out of equity investments and putting it in stable value cash. This is what happens at bottoms, unfortunately, for individual investors. There is talk of a new stimulus this week. It's ranging from just increasing that which we've already done. The PPP, Payroll Protection Program, which helps businesses keep employees, has been wildly popular, oversubscribed. So there's one theory that says put more money in that. There's a stimulus package for bridges and highways on the table. Everything's on the table right now. And that, again, while that causes certain issues on the back end of this, inflation and how we pay the debt down, for now, the government is remarkably focused on making sure there's enough liquidity to keep everybody going and then be able to come back when this thing is done. So the shape of the economy will determine on how long this lasts, how much stimulus gets put in, and how fast we come out. V-shape, U-shape, whichever way it turns out to be, it's all about, frankly, the Fed, it's about the Treasury, and it's about the scientists coming up with the therapeutics and the testing capabilities. So there is talk now, they're starting to talk about bringing the economy back. People who've already had it going back to work, already had the virus going back to work, getting testing out, taking temperatures. You're starting to hear that chatter, and if we can get people back to work, better chance of a V-shaped recovery. Just one quick side note, I heard a comment from one of the scientists on one of the press conferences, and the quote was, if people have to be inconvenienced, then so be it to save lives. And while we all want to save lives, that quote was particularly troubling. This is more than an inconvenience. This is the financial destruction of lives. And so what we're starting to hear this week, which is better than the weeks prior, is a balance of economy and science and the talk about, hey, we can't just destroy the economy, we can't destroy people's lives. So again, this is starting to turn. In terms of the market has rallied 10% since the beginning of April. That's a very fast move, and it's moved over 20% off the bottom. The second biggest 10-day rally in history. The market's moving fast. It's a broad market advance, meaning everything's going up. The volume of positive movement is much higher, tenfold of negative on these big up days. There's a lot of technical characteristics to this which show strength. That's the good news. We're seeing stocks come above their 50-day moving average. That's a data point that's very important. That data point is improving every day. So this is, without question, one of the biggest moves coming off of perhaps one of the worst quarters in the market history. Again, we went down with a record pace. We're coming up with a record pace as well. Will that last, or will we retest? Well, what we know is traditionally in these severe bear markets, we get these rallies, we tend to retest. The temptation is to assume that, sell, come back in, buy later. Unfortunately, again, we're dealing with uncharted territory here. If we get a scientific or a biological advancement, if the economy comes back quicker, if these numbers continue to decline, trying to trade this thing could turn out to be an error. So we're going to look at this market. We're going to continue to assess the equity markets. But what we're always going to say to investors, stay focused on your time horizon. This is our portfolios are long-term portfolios. We have to stay focused there. Again, we're still buying into this. As the market moves around, we'll keep taking bites where there's value. Credit has started to improve. We've talked about in prior updates that credit spreads, the difference between the return on a bond and a treasury, got really wide. That's an indication of risk. Those are starting to contract a little bit. Last week, we started to buy into that credit because some of these bonds were cheap. Things are starting to improve there. So, in conclusion, the markets are starting to show some promise. We're not out of the woods yet. There will be more volatility. We've made the move halfway back from the bottom. And so this is a point where we pause and we ask the question, are these improvements going to take hold? I was asked a question in an interview here, well, is hope enough? Well, hope was enough to get us from 2,200 to 2,700. Reality is going to have to take us to the next level. So for now, hang in there. We're here to answer any questions. Again, the news flow is slowly starting to improve. The markets are starting to rally. They're showing some strength. Have we made a bottom? Time will tell. What's important here, we're going to stay focused, we're going to stay disciplined, and we're going to keep monitoring our allocations and valuations and make moves when appropriate. Thank you very much for the time, and once again, please call us if you have any questions.